September 3rd, 1929, a Tuesday morning in Manhattan. The air carried the smell of newsprint and cigar smoke, drifting from the financial district. Inside the marble lobby of the Guarantee Trust Company on Broadway, a businessman in a wool suit approached the teller window, clutching a leather passbook. His hands trembled slightly, not from cold, but from a growing sense of dread he couldn't quite articulate. Stock prices had been climbing for years, soaring 300% since 1924. Everyone said prosperity was permanent, but something felt wrong. He requested a full withdrawal, $12,000 in cash. The teller raised an eyebrow, but asked no questions, no forms, no waiting period, no penalty calculator. Within 20 minutes, the businessman walked out with bills in his briefcase. His entire life, savings converted to currency he could hold. 2 months later, on October 24, 1929, the stock market collapsed with violence that would echo through generations. Banks across America failed as panicked depositors lined up outside locked doors. Over 1,350 banks would collapse in 1930 alone, with $7 billion deposits frozen by 1933. But that businessman was safe. He had his money. He could survive the storm. But here's what nobody talks about. Now imagine trying that today. You sense danger approaching in January 2026. The same instinctive dread. You attempt to do what he did, withdraw your wealth and get to safety before the crowd realizes what's happening. You log into your 401k account. You see $180,000 saved over 20 years of discipline and sacrifice. You click Withdraw. A penalty calculator appears instead. Federal income tax at 24%, state tax at 6%, and the 10% early withdrawal penalty for touching your money before age 59 and a half. Your $180,000 becomes $108,000 before you see a cent. But that's not even the worst part. The withdrawal doesn't execute immediately. It enters a processing queue, taking 7 to 10 business days under normal conditions. During financial panic, when everyone's trying to exit simultaneously, those systems can freeze entirely. Not because your bank is failing, but because modern finance was designed to prevent exactly what the 1929 businessman did: escape. This is the difference between 1929 and 2026 that nobody's discussing. It's not just that another crash is coming. Economic forecasters at J.P. Morgan estimate a 35% probability of recession in 2026. It's that when it arrives, you won't be able to do what previous generations could. Your wealth is trapped inside systems with time locks, penalty gates, and legal restrictions that slam shut when everyone tries to leave at once. Every mechanism trapping your savings was built deliberately, not to protect you, but to protect the system from you making the rational decision to save yourself when disaster approaches. How did we get here? Why are the traps tighter than ever? And why does 2026 make 1929 look like a rehearsal? To understand what's coming, we must first understand what we lost. The 1929 crash destroyed millions of lives, triggering the longest and deepest economic downturn in modern history. Unemployment eventually reached 25%. Industrial production fell by 46% between 1929 and 1932. Families stood in breadlines. Thousands lost their homes. The Great Depression lasted over a decade, ending only when World War II forced massive government spending in 1941. But that system had one feature that today's eliminated completely: immediate access to your money. In September 1929, your savings account worked simply. You walked into your bank, presented your passbook with handwritten ledger entries, and requested your balance. The teller counted cash from the drawer. Same-day withdrawals of your entire balance were standard. No processing periods, no approval workflows, no suspicious activity reviews. If you wanted your money, it was yours within the hour. Stock ownership was equally direct. When you bought shares, you received physical stock certificates with your name and share count. These weren't digital entries in a database. They were property you held. To sell, you could find a buyer directly, hand over the certificate, and receive payment. Or sell through a broker with settlement in 3 days, not 3 weeks, and not subject to trading halts. This meant investors who sensed trouble had options. They could liquidate positions, withdraw from banks, and convert everything to cash or gold. Many tried. The problem wasn't that the system prevented escape. The problem was most people didn't see it coming until too late. When the crash hit on October 24th, those positioned in cash survived. Those who hesitated, who believed the reassurances, who waited one more day, were destroyed. But destruction came from their decisions, not from the system physically preventing action. Compare that to today. Compare it to 401k accounts where money is locked behind penalty walls until age 59 and a half. Compare it to banks that can freeze accounts for suspicious activity if you withdraw too much too fast. Compare it to investment funds that can legally suspend redemptions during market stress. The 1929 generation faced a devastating crash, but they weren't facing a system designed to trap them. We are. After 1929, regulators didn't just try to prevent another crash. They built something more ambitious, a financial system that could prevent people from escaping during a crash. Every major reform between 1933 and 2010 had the same goal: eliminate ordinary people's ability to trigger bank runs and market panics by withdrawing their money. They called it systemic stability. But what it created was a cage. The first lock was the 401k, created in 1978 and sold as a tax advantage. The pitch was simple: defer taxes now. Pay later in retirement when your income is lower. Millions of Americans accepted it. By 2026, over $7 trillion in American retirement savings sits locked in these accounts. But here's the problem nobody explained. You contribute throughout your working life, but cannot access it without paying combined penalties and taxes that typically consume 35% to 45% of your withdrawal. The Internal Revenue Code imposes a 10% penalty tax on any withdrawal before age 59 and a half. Add federal income tax at 22% to 37%, depending on your bracket. Add state tax averaging 5% to 10%. Suddenly your $100,000 becomes $60,000. That's the first trap, but penalties are just the visible lock. The second lock is time. When you request a 401k withdrawal, you don't get money instantly. Plan administrators process requests, taking 7 to 10 business days under normal conditions. Why? Because your 401k isn't actually sitting in cash. It's invested in mutual funds, target date funds, company stock. When you request a withdrawal, the administrator must sell those positions, wait for settlement, calculate taxes, and issue payment. During market stress, when everyone's withdrawing simultaneously, timelines extend indefinitely. Some providers can legally suspend withdrawals entirely for administrative review or plan valuation uncertainty. This isn't theoretical speculation. This happened during 2008. Fidelity, one of the largest 401k administrators managing over $2 trillion in assets, suspended certain withdrawal requests for weeks during the 2008 financial crisis. Participants logged in to find temporarily unavailable messages. Their money was there on screen, showing in their account balance, but they couldn't access it. Not because they lacked funds, not because the plan was bankrupt, but because the system includes gates that close during volatility. Think about what that means. You're watching your retirement account drop 5% per day. You submit a withdrawal request, willing to accept the 40% penalty hit. The request enters a queue. Days pass. The market drops another 15%. Your request is still processing. By the time it's approved, you've lost 35% of your original balance, then you pay 40% of what's left in penalties and taxes. Your $200,000 retirement account yields $78,000, and that assumes the withdrawal gets approved at all. But the 401k trap is just the beginning. It gets worse when we look at banking itself. In 1929, cash meant cash. Physical currency you could hold, spend, or hide under your mattress. If you had $10,000 in the bank, you could withdraw $10,000 in bills. Today, try withdrawing $10,000 or more in cash. Federal law requires banks to file a currency transaction report with FinCEN, the Financial Crimes Enforcement Network. You're not doing anything illegal. You're accessing your own money, but your name gets flagged in a government database tracking large cash movements. Banks also have discretion to delay withdrawals for suspicious activity review if they determine your request is unusual. How do they determine unusual? That's entirely subjective. Withdraw too much too fast, and your account can be frozen while they investigate, a process that can take 5 to 30 days. But even if your bank approves immediate withdrawal, there's another problem: physical limits. Daily ATM limits typically cap at $500 to $1,000, meaning even with $50,000 in your checking account, physically accessing it would require 50 to 100 separate transactions over weeks or months. The crisis would be over before you could extract your own funds. Branch withdrawals face similar constraints. Most bank branches don't keep large amounts of cash on hand anymore. Request $20,000 and you'll likely hear, "We need to order that. Come back in 3 to 5 business days." During a bank-run scenario, when everyone's requesting cash simultaneously, those timelines extend indefinitely or become impossible. We saw this play out in 2013 during the Cyprus banking crisis. Cypriot banks froze all accounts for 12 days. When they reopened, daily withdrawal limits were capped at $100, approximately $130. Citizens watched their account balances on screens but couldn't access them. Businesses couldn't pay suppliers. Families couldn't buy groceries. The government declared it temporary, necessary to prevent bank collapse. The freeze lasted 18 months. Greece repeated the pattern in 2015. Daily withdrawal limits of $60. ATMs ran dry within hours each morning. Capital controls remained in place for 3 years. In both cases, the banks didn't actually fail. They remained solvent on paper. But depositors couldn't access their money, so functionally, what's the difference? This is what modern banking has become. Not deposits you can withdraw, but digital ledger entries you can access only when the system permits. But there's an even more insidious trap waiting in investment accounts. Most investors don't realize their ability to sell depends on market makers maintaining liquidity, and that liquidity vanishes when you need it most. During March 2020, over 200 exchange-traded funds traded at 10% to 20% discounts to their underlying holdings. Let me explain what that means. You own an ETF showing $100,000 in your account. The ETF holds stocks worth $100,000. But when you try to sell during panic, buyers offer only $85,000. Not because the stocks fell that much, but because market structure broke down. There weren't enough market makers willing to facilitate trades. Your $100,000 asset became $85,000 the moment you tried to convert it to cash. Instead of protecting you, the system forces you to sell at the worst possible moment for the worst possible price. Mutual funds have more explicit traps. SEC Rule 22E4 allows funds to maintain up to 15% holdings in illiquid assets. When those thresholds are breached, funds can suspend redemptions entirely. This isn't theoretical. The Woodford Equity Income Fund in the UK suspended redemptions in June 2019, trapping $3.7 billion, approximately $4.8 billion for over 3 years. When redemptions finally resumed, investors received roughly 70 cents on the dollar. Real estate investment trusts did the same during 2008-2009, suspending redemptions for an average of 18 months. Private equity funds have standard 7-year lockup periods with 0 early withdrawal options. You invest $50,000 in a private equity fund in 2020. By 2026, The fund has lost 30% of its value due to over-leveraged portfolio companies collapsing. You want out. Too bad. Your money is locked until 2027, and you'll receive whatever remains at that point. Every one of these restrictions was sold as protecting investors or maintaining market stability. But the effect is identical. Your money is no longer accessible on demand. It's accessible on the system's terms, according to conditions that can change during crisis. The 1929 investor could grab cash and run. The 2026 investor will click Withdraw, see a loading screen, and discover the request is pending, subject to delays or suspension if conditions deteriorate. By the time access is granted, the wealth they were protecting will have evaporated. These mechanisms exist right now, embedded in every retirement account, every bank account, every brokerage and fund. They're waiting for the moment everyone tries to use the exit simultaneously. The traps have always existed, but 2026 is when they become catastrophic, not because the mechanisms changed, but because of what's underneath: unprecedented debt, algorithmic trading, and a Federal Reserve that's already fired its bullets. Start with leverage. In 1929, investors could buy stocks with 10% down, borrowing 90% on margin. That 10-to-1 leverage turned a 10% market decline into total wipeout. Regulators raised margin requirements to 50% after the crash, thinking they'd solved it. But today's leverage doesn't live in visible margin accounts. It lives in derivatives, collateralized loan obligations, and private equity structures, creating 20-to-1 or even 50-to-1 leverage hidden from view. The Bank for International Settlements estimates over $600 trillion in notional derivatives exposure exists globally as of 2025. When that unwinds, it won't happen over months like 1929. It'll happen in hours as computers execute pre-programmed selling strategies. Unlike 1929, when selling meant humans shouting orders on a trading floor, today 70% of volume comes from algorithms executing millions of trades per second. These algorithms sell when volatility exceeds thresholds, when momentum breaks levels, when correlations indicate stress. When one starts selling, it triggers others, creating cascades moving faster than humans can react. We saw a preview in March 2020. The S&P 500 dropped 34% in 23 days, the fastest bear market ever. Trading halted multiple times through circuit breakers designed to let cooler heads prevail. But those halts didn't stop selling. They compressed it into smaller windows, creating more violent moves when trading resumed. Now imagine that scenario with all the traps I described fully engaged. You watch your 401k drop 30% in 2 weeks. You submit a withdrawal request, willing to pay the 40% penalty. The request sits in processing while the market drops another 20%. By the time it's approved, you've lost 50%, then pay 40% of what's left in penalties. Your $200,000 retirement account yields $60,000. That assumes the withdrawal gets approved. During peak crisis, administrators can invoke extraordinary circumstances, clauses suspending all distributions. You're watching the numbers shrink, unable to act, trapped by systems designed for this exact purpose. The Federal Reserve will attempt intervention, just as they did in 2008 and 2020. They'll cut interest rates to zero. They'll launch quantitative easing, buying trillions in bonds and securities. They'll establish lending facilities for banks and corporations. But here's the problem. Those tools assume the crisis is temporary, a liquidity problem that can be solved by providing cash. The 2026 crisis won't be about liquidity, it'll be about solvency, about debts that can't be repaid, assets that can't be sold, and systems that can't function when everyone tries to exit simultaneously. The Fed can't print trust. They can't print functioning markets. And they can't unlock the digital cages that trap your wealth when you need access most. In 1929, roughly $8.5 billion in margin loans were outstanding. When the market crashed, those loans were called, forcing sales that accelerated the decline. But once the selling was done, once the weak hands were shaken out, the market could find a bottom. It took years, but a bottom existed because forced sellers eventually ran out of things to sell. In 2026, the forced selling never ends because algorithms don't run out of instructions. They follow pre-programmed rules. If volatility exceeds X, sell Y%. If correlations break down, hedge by selling Z. Each sale triggers another algorithm's sell threshold, creating feedback loops that accelerate exponentially. Meanwhile, ordinary investors are trapped behind withdrawal delays, penalty calculations, and frozen redemptions. Watching their wealth evaporate on screens they can observe but cannot act upon. This is the fundamental difference between 1929 and 2026. In 1929, the crash was brutal because too many people could escape and did, triggering bank runs that collapsed the system. In 2026, the crash will be catastrophic because too few people can escape, creating a digital cage where wealth evaporates while owners watch helplessly. The 1929 businessman walked into his bank on a Tuesday morning and walked out with cash. His instinct saved him. That option no longer exists. The exits have been removed, replaced with processing queues, penalty calculators, and suspension clauses. Your grandfather could grab his money and run. You can't. So what happens when the 2026 crash arrives? The immediate consequences will unfold in 3 phases. Phase 1. Recognition. Investors notice declining values and submit withdrawal requests. Markets remain functional but stressed. Processing queues lengthen from 7 days to 14 days, then 21. Penalties are paid. Early withdrawals execute, though slowly. This phase creates the illusion that escape is possible. Phase 2. Acceleration. Withdrawal requests surge exponentially. Mutual funds breach their 15% illiquidity thresholds and suspend redemptions. Retirement plan administrators invoke extraordinary circumstances clauses. Banks implement informal withdrawal limits, asking customers to return tomorrow or order larger amounts in advance. ATMs run dry by mid-morning. Circuit breakers halt trading repeatedly, compressing panic into shorter windows. Phase 3. Lockdown. The system freezes. 401k withdrawals show temporarily unavailable. Brokerage accounts display processing delays. Fund redemptions are suspended pending review. Government officials appear on television explaining these measures are temporary and necessary to maintain stability. They promise normal operations will resume soon. They won't, because once the gates close, reopening them triggers the very panic the lockdown was meant to prevent. So the freeze extends. Days become weeks. Weeks become months. Your retirement account balance remains visible on screen, but you can't access it. You can't sell, you can't withdraw, you can only watch the number shrink. The long-term consequences will reshape everything. A generation will learn the lesson their grandparents knew. Wealth you cannot access during crisis is not wealth. It's a promise the system can break. Trust in retirement accounts, banks, and investment funds will collapse, just as trust in banks collapsed during the 1930s. But unlike 1929, there won't be a clear path to recovery because the traps remain in place. The penalty walls still exist. The processing delays are still baked into the system. The suspension clauses remain in fund documents. Even after markets stabilize, investors will know they're trapped, that their wealth is accessible only when the system permits. This teaches us something fundamental about modern finance. It was never designed to serve you in crisis. It was designed to survive crisis by preventing you from acting. Every rule, every restriction, every processing delay exists to keep your money inside the system when you most need it outside. We see this pattern today in early 2026. J.P. Morgan estimates a 35% recession probability. EY forecasts K-shaped economic growth with wealthy households continuing to spend while lower-income families face pressure from rising prices and stagnant wages. The global economy shows resilience on paper, but underneath, the same debts, leverage, and structural instabilities that created 1929 and 2008 remain, only larger and more interconnected. The crash is coming, not because of any single event or policy mistake, but because systems built on exponential debt growth, infinite leverage, and digital control mechanisms eventually reach breaking points where the math stops working and the exits stop functioning. The question isn't whether it will happen. The question is whether you'll be inside the cage or outside when it locks. September 1929. A Manhattan businessman sensed danger and withdrew $12,000 in cash. 2 months later, the markets collapsed. Banks failed. Fortunes vanished. But he survived because he could act on instinct and the system permitted escape. January 2026. You sense the same danger. You attempt the same action. You log into your 401k. You click Withdraw. A penalty calculator appears. A processing queue begins. Time locks engage. And you realize too late that the option your grandfather had, the option that saved him, no longer exists. This is what we've lost, not just wealth, though that will disappear too. We've lost the ability to protect ourselves during crisis. We've lost immediate access to our own money. We've lost the escape routes that previous generations used to survive financial catastrophes. What replaced them? Digital cages with penalty walls, processing delays, and suspension clauses that close when danger arrives. Systems designed not to protect us, but to protect themselves from us making the rational choice to leave. Every number you see on your retirement account screen, every balance in your bank account, every investment fund statement, those aren't assets you control. They're promises that can be suspended, delayed, penalized, or frozen the moment conditions deteriorate. The 1929 crash was devastating because of speculation, leverage, and debt. The 2026 crash will be catastrophic for a different reason, because the digital cages will prevent escape even for those who see danger coming. Your grandfather could grab his money and run. You can't. But you can still prepare by understanding what's coming and positioning yourself before the crowd realizes the gates are closing. Because once everyone tries to leave simultaneously, the systems freeze, the wealth evaporates, and you're left watching a number on a screen shrink by the hour while you remain helpless, trapped inside a system built for this exact outcome. The choice is yours. The timeline is closing. This is the hidden history. If you want to understand the economic forces reshaping our world, subscribe now. Because when the next chapter is written, you'll want to be among the few who saw it coming.